Welcome back to Financial Accounting FRK 321. Group Statements. This is the second of two lectures in Change in Degree of Control. Please note that this recording carries copyright. Please have your handouts in front of you and ready. If you do not have a handout, you will find the handout on ClickUp. Change in Degree of Ownership, lecture number 2. Previously, we had a look at the acquisition of an additional interest in an investment, becoming an associate or a subsidiary, additional investment in associate, becoming subsidiary, additional investment in a subsidiary, that of course stays a subsidiary. There you also can see the methods of piecemeal acquisition as we discussed previously. For today, a business combination that eventually leads to control is sometimes achieved in stages or in steps. Now, in such an acquisition, the acquirer shall remeasure its previously held equity interest in the acquiree at the acquisition date fair value and recognize the resulting gain or loss, if any, in the profit or loss. So what we are saying there is your previous investment which you had in this company will be readjusted to fair value, and any gain or loss that you calculate in this readjustment will be taken directly to the profit or loss. So let us do class example number 2. P, the parent, or Poly Limited in this case, owns 30% in the associate, Suzy Limited. Then, in the next year, 30 April 20.2, they purchase another 35% additional interest in Suzy Limited, giving us a 65% interest. Now we've obtained control and now it is a subsidiary. So let us now have a look at this question. Please turn to page 15 of your handouts and look at class example number 2, piecemeal acquisition over 2 financial years where an associate company becomes a subsidiary. At this stage, I again suggest that you stop the recording, read through class example number 2, familiarize yourself with the information, and then we can together look at the explanation of this question. In the meantime, I will just scroll through the question while you pause it. There you have the trial balances as given. Then we have additional information. And the second part of additional information up to suggested solution. Good. By now, I assume you have read through the question and we can now continue. Firstly, just take note that Poly Limited and its subsidiaries, that's the first column, is shown in that column. That is separate from Suzy, which is not yet a subsidiary. So the non-controlling interest that you see there, the 60,000, relates to other subsidiaries of Poly Limited. So don't get confused with that and that of Suzy. And there they also tell you that assume that the non-controlling interest in other subsidiaries remain unchanged throughout the year. So that should not have an effect of what we are doing in this question. Poly Limited. Poly acquired 9,000 shares in Suzy on incorporation of Suzy on 1 January 20.1. Now I would suggest that you always draw up a timeline that you can see when it was acquired and when any changes was made to this shareholding. So those 9,000 shares represents a 30% interest, because as you can see there, the number of ordinary shares issued were 30,000. 9,000 out of 30,000 gives me a 30% share, which then is an associate. Then, on 30 April 20.2, Poly Limited purchased a further 10,500 shares, which equates to 35%. From the non-controlling shareholders of Suzy Limited. The next sentence is a very important one. On 30 April 20.2, the shares of Suzy Limited traded on the market at R1.55 per share. So that gives us the market value of the share at that stage. And you will see later on where we are going to use that in our question. Now that you've got the information, the other thing that you must remember is that this is an interim acquisition. It was done in the middle of the year. So please, when you do your calculations, remember to allocate it during the year. So now, the investment in Suzy Limited, let's do the analysis. Initial acquisition of the investment in Suzy is the 30,000 shares, and we own 9,000 of those shares, 30%. Then since acquisition to the beginning of the current year, we have retained earnings of 7,000, and our portion of that is the 2,100. Sorry, 2,100. Then, in the current year, up to the date when it is still has to become a subsidiary, before it becomes a subsidiary, it is still an associate. And we must calculate that portion as well. So therefore, we have to calculate what is the profit for that period, firstly. And as you can see right at the bottom, the 11,667 minus the 3,267 times 4/12, which is our period, which it is still an associate. That gives us the 2,800. Our 30% is the 840 in that case. Now that we've calculated all these amounts, the 9,000, the 2,100 and the 840, we can now see that the carrying amount of the investment in the associate at 30 April 20.2 is 11,940. That is the carrying amount. And as we said earlier, we have to calculate the fair value of the existing interest at this date as well. So there we have calculated the fair value, and as we said, the existing interest. So what did we have initially? We had 9,000 shares initially, our existing interest, and at the fair value of R1.55 per share, that gives us a value of 13,950 as the fair value of our investment in the associate. Then you have to take the difference between the two, which is the 2010, and that is your consolidated fair value adjustment, which will be taken straight to the profit and loss for the year. Let us just equate this back to the theory. A business combination that eventually leads to control is sometimes achieved in stages. And this is what we have in this question. The first stage, it was an associate at 30%. Now the second stage will be the extra 35%, giving us full control at 65%. But our initial investment must first be fair valued. So there we say, in such an acquisition, the acquirer shall remeasure its previously held equity interest, that is the 9,000 shares, in the acquiree at the acquisition date fair value, the 155, and recognize the resulting gain or loss, if any, in profit or loss. And as we saw, we calculated the fair value at 13,950. We compare that to the carrying amount of the associate at that date, and we get a difference of 2010, which will be taken to the profit or loss. Let us have a look at the consolidation journals that flows from these calculations. So initially, the contra out of the mark-to-market reserve, the elimination of that, and then the line items that we've just done. The retained earnings up to the beginning of the current year, 30% of 7,000, 2,100. The income from the associate for the current year, that 4 months while it was still an associate, that must be allocated to the carrying amount of the associate. And then finally, the fair value adjustment that we've just achieved or calculated, that must be taken into account. Add those items up and they will be debited to the investment of Suzy Limited at 4,950. If you take that together with the initial investment of 9,000, then you reconciliate with the fair value of 13,950 at the date that it becomes a subsidiary. Now that we have calculated the fair value, as you can see there, and the fair value the fair value, that one there, 13,950, and the fair value adjustment, we can now go and analyze do the analysis of the subsidiary. And our starting point is the 39,800 that you see there. So let us do that now and consolidate the subsidiary. The subsidiary, firstly, we have the share capital, which is the 30,000 given to us. Then the retained earnings, as we saw, the 7,000 and the 2,800. And remember, this is now the 100% figures of Suzy Limited. That gives us net assets of 39,800. We calculate our portion, because we've now got 65,000, as the 19,500, the 6,370 being then 25,870. Again, to be able to calculate the goodwill or gain on bargain purchase, we will have to look at the consideration that we paid for these additional shares, as well as the fair value of the interest already held in the associate, plus of course the non-controlling interest. So our portion is the consideration, as we said, the 16,000 that we paid for this new additional 35%, as well as the fair value of the previous 30% that we already held, 13,950. Those two items together makes up the 29,950. Now we can calculate the goodwill at 4,080, and we've done our calculations. From here onwards, we only have to go through the motions. So we take the since acquisition portion, and we take 8/12 of that, allocate it for the year, and 100% of that is 5,600. Our portion, the parent's portion, is the 3,640. But remember, that is our portion. Now we have to do the disclosure. So let us look at the consolidated disclosure. Firstly, consolidated statement of profit or loss and other comprehensive income. Remember the associate portion of the profit for the year while it was still an associate, 840. Also, the fair value adjustment of the associate, the 2010. All of this must be taken to Sploky. And then, as a subsidiary, while it was a subsidiary, 100% of those items, 5,600, is taken into account. But due to that, we have to deduct the non-controlling interest line item, 1,960, to get to the parent's portion of the profit for the year. The consolidated statement of changes in equity. There we start off with the opening balance, 30% of the 7,000 being the 2,100, while it was still an associate, plus 65,000 from the parent, Poly Limited. We have also created the non-controlling interest. So when you look at the analysis, you will see there, when we purchased this additional interest, we received or we created a non-controlling interest item at the date of acquisition, 13,930. And then finally, in the same statement, we have the profit for the year. And in this case, we show again, for calculation purposes, only our portion of the 5,600 profit being 3,640, plus the 840 while it was still associate, plus the fair value adjustment, and then do not forget the parent's portion, which is 20,500 minus the tax of 5,500, and that gives us, in the retained earnings column, 21,940. please, remember, when you draw up the statement of financial position, that we have to include 100% of all SS line items. In other words, 100% of profit, 100% of assets, 100% of liabilities, and we also have to create the non-controlling interest, which we've done in the previous slide. Let us look at the consolidation journal while it is now a subsidiary. Remember, subsidiary, we bring in 100% of everything, and against that we look at non-controlling interest. So the full share capital of Suzy Limited, the full retained earnings up to the beginning of the current year of Suzy Limited, as well as the income while it was still an associate. Remember, we want to calculate the goodwill or gain on bargain purchase at acquisition of the subsidiary. And this is now the period we're working with. The non-controlling interest that we've created, plus the initial investment in Suzy Limited at fair value 13,950, and then the subsequent investment in Suzy Limited at cost 16,000. Remember also, then you get the goodwill, which is then our difference that we've calculated, as you saw in the analysis. Now, during the current year, the 5,600 is taken into account in the profit or loss in full, and against that, the non-controlling interest want their portion, so their portion is 1,960. We put through that journal, and we have done our consolidation journals. Finally, our statement of profit or loss and other comprehensive income. Look at the line-by-line item. Now, we've got the gross profit there initially, which is 20,500 for the parent and 778 for the subsidiary. But remember, this is only while it was a subsidiary. So this will be the profit for the year times 8 over 12 and giving us the 778. Then the other income, that line item is the fair value adjustment which we calculated at that stage. And then look at the wording of the next item. You must have this wording exactly as we have it here. Share of profit of the associate until the date on which this associate became a subsidiary, 840. Then again the tax expense, that of the parent, as well as 8 over 12 of the subsidiary, and that will then give us the profit for the year. Right at the bottom, there's the analysis of that profit. 21,490 is attributable to the parent, whereas the non-controlling interest gets the 1,960. Well, thank you and good luck.